Welcome back, gang. In lesson 1, we learned how to calculate our net worth by creating a personal balance sheet. This lets us do a financial physical at any point in time. In this lesson, I'm going to show you how to calculate a second measure called net income. If net worth is part of our financial physical, then think of net income as how we measure our financial diet, exercise, and all of the other things we do to build wealth over time. Let's get right to it. We calculate our net income as our revenue minus our expenses. Let me repeat this. Our net income equals our revenue minus our expenses. These terms may sound foreign to you right now, but I promise they will make sense by the end of this video. Revenue includes any amount we earn plus any amount we win and also any amount we receive as a gift. What are some examples? Well, an easy one is the amount of compensation before taxes that you earn when you go to work. This includes things like salary, hourly wages, bonuses, and any other cash benefits received. Another example of revenue is the money that we earn on our investments and on our bank accounts. Think of things like interest, dividends, and realized gains. Realized what? Realized gains occur when we sell an asset at a higher price than what we bought it for. For instance, let's say I bought my home 5 years ago for $300,000 and today I sold it for $450,000. The $150,000 increase represents my gain. In other words, I gained money from buying a house at one price and selling it later for a higher price. This gain is called a realized gain because I actually sold the house and the gain is mine to keep. We'll do a deep dive into investments and other assets later, but for now, just know that a realized gain is part of your revenue. In our house example, let's say instead of selling it today, we decide to hold on to it. Do we still have a gain? Yes, in this case, we would have an unrealized gain. An unrealized gain just means that the asset's value has gone up since we bought it, but it's unrealized because we haven't sold the asset yet. And the asset's value could continue to fluctuate until we do sell it. Since fluctuations in an asset's value are mostly out of our control, I teach that unrealized gains are not included as revenue until they become realized. Let's pause here for a moment. The part we just discussed might feel a bit complicated. If you don't feel comfortable with it yet, watch that part again. There is no shame in going slowly and taking a few passes through the material. In fact, I encourage it. You will get a lot more out of this class if you take the time to really understand it. Additionally, if you win money gambling or through a lottery, that's revenue too. Lastly, did your grandmother give you cash for your birthday? Yep, that's also revenue. In summary, if you earned it, won it, or it was gifted to you, then it's likely revenue. Okay, if revenue is anything we earn, win, or are gifted, then what the heck are expenses? Expenses generally refer to anything we purchase, spend money on, are charged for, or lose that isn't an asset. Some examples include food, clothing, rent, utilities, cell phone service, internet service, streaming service, vacations, insurance, taxes, gasoline, and a whole lot more. Make a donation, that's an expense too. And don't forget any realized losses or money lost through gambling or the lottery. We'll discuss realized losses in a few minutes. Sometimes it's difficult to distinguish between an asset and an expense. After all, you pay money for both of them. An easy method I use to distinguish the two is asking one basic question. Does this good or service that I purchase have a measurable value that I could resell it for? If the answer is yes, then it's likely an asset. And if the answer is no, then it's probably an expense. Let's take shoes, for example. When someone chooses to buy a pair of shoes, they are usually looking to wear the shoes and probably can't resell them for any measurable value. For this person, purchasing shoes is a living expense. On the other hand, let's assume a person bought a pair of very rare 1980s basketball shoes as a collector's item. You know those red and black ones named for number 23. These shoes have a substantial value and the person could resell them at a measurable price. In this case, the collectible shoes are an asset. This determination sometimes requires discretion, but for the most part, you'll be able to separate assets from expenses fairly easily. Here's a list to help you out. There is another important distinction I'd like to call attention to. We learned in our first lesson that assets and liabilities are measured at a point in time. Revenue and expenses, however, are measured over a period of time, like 1 year, for example. When you add up everything you earn over a period of time, and then you subtract all of your expenses during the same period, the remaining amount is called your net income. Net income represents how much of your earnings you have left after subtracting all of your expenses. Why is this such an important concept to learn? Easy. In order to build wealth, you need to earn more in revenue than you spend on expenses. Let me say that again. In order to build wealth, you need to earn more in revenue than you spend on expenses. This simple equation tells us at a basic level, there are only two ways to increase our net income: earn more money and reduce our expenses. Now, we can never eliminate all of our expenses, as we still have to live, and living costs money. Instead, I like to say it's good to limit our expenses to a reasonable level. When we list our revenue, expenses, and calculate our net income on a piece of paper or maybe even in a spreadsheet, we create something called a personal income statement. This personal income statement shows you how well you did at many things that go into improving your financial health. You can make a personal income statement for any period of time. I think it's important to put one together for every calendar year at a minimum. If you want to track your wealth more often, you might consider doing one every 6 months or even every 3 months to see how your earnings compare to your spending. There's no definite answer as to how often you should make a personal income statement. I'll leave that power up to you. But again, doing one for every calendar year is a good rule at a minimum. The first step to creating your personal income statement is listing all of your revenue for a period of time. Your revenue is pretty easy to determine. Add your gross compensation before any taxes or deductions that you receive from working. And then add any other sources of revenue, such as interest, dividends, realized gains, and also gifts and gambling winnings. Much of this comes from things like your bank or brokerage statements, and of course, from your payroll information. Next, list all of your expenses for that same period of time. If you make your payments electronically, these can easily be obtained from your bank or credit card statements. If you pay cash for your expenses, you'll need to do an estimate of how much you were spending for the period. You'll also want to include all the taxes and insurance you're paying, including those payroll taxes that are deducted from your pay. Don't forget any gambling losses or donations made. Lastly, you'll want to include any realized losses. That is, did you sell an asset, such as an investment, at a price lower than what you paid for it? Now, add up your revenue, subtract your expenses, and voila, you have your net income. You can create a personal income statement for a prior period, like last year, or you can create an estimated personal income statement for a current or future period. Over the long term, we want to increase how much we earn, whether that's through acquiring education, skills, and pursuing better opportunities. And we want to limit our expenses to a reasonable level. One question I get a lot is, what happens if your expenses are more than your revenue? Well, folks, then you have a net loss. If this is the case for you, don't panic. We can get back on track by analyzing our earning and spending habits and making some changes for the better. We can help to limit our expenses by creating and sticking to a budget. In our next lesson, we're going to show you a simple way to create a budget. We're also going to see how our net income increases our net worth and how a net loss decreases our net worth. And finally, we'll show you a couple of simple ratios that will help you assess your wealth building at a high level. That brings us to 2 homework assignments before you start lesson 3. Don't look at them as homework. Look at them as tools to assess your wealth building. First, create your own personal income statement based on the last calendar year, either on paper or using a computer spreadsheet. Don't forget to write the year at the top so you know which period the statement relates to. If you don't have access to the actual numbers right now, use estimates instead. Second, decide on a plan for how often you are going to create a personal income statement and set reminders on your calendar so you don't forget. Congratulations! You have now finished lesson 2 of the Opus Monete program. Taking control of your finances takes effort, but it's well worth it. Here's a little secret. The first 3 lessons are by far the most important of the course, and you're already 2/3 of the way there. Keep it going. You got this. If you have any questions at all, please contact me at opusmonetequestions@gmail.com or comment below and I will try my best to get back to you as soon as I can. Thanks for watching. We rely heavily on recommendations. Please follow us on Instagram, subscribe to us, and like this video on YouTube, and share our program with your family and friends. See you all in lesson 3. Peace!